The exchanges are shut tight, screens are black, spot is stuck at 79.25. To the public, it looks like nothing's up. It is a holiday. Paper traders should be resting unplugged and fast asleep. But behind closed doors, this ain't a weekend of rest. This is a weekend of pure panic. When real money like silver rips 10% in a single session, the problem is no longer price. The problem is total survival. Somewhere in Lower Manhattan and deep inside the Federal Reserve emergency meetings are going on right now. Not because the fiat system is solid, but because it is trapped. A 10% rip is not a trade. It is a critical solvency event. It shatters risk models, it destroys margin assumptions, and critically, it threatens the one structure holding the whole market together, the clearinghouse. When massive leverage hits volatility, math stops being theoretical and starts becoming absolutely lethal. Bullion banks do not trade silver with cash. They trade with credit stacked on top of more credit. 20-to-1 leverage, sometimes 50-to-1. In calm times, this prints easy fiat. In violent times, it completely detonates their balance sheets. A 5% rip against a paper short wipes out all equity. A 10% rip does not just hurt. It deletes your existence. That is why this long weekend matters. Because if a massive short cannot meet its obligations when markets reopen, the clearinghouse must step in. And if the clearinghouse cannot eat the loss, the whole system freezes. This is not speculation. This is the market structure. And when the rig starts to crack, the elites in charge do not ring a bell. They do not issue warnings. They just meet in secret and look for ways to change the rules. What you are witnessing is not confidence, it is essentially containment. This chapter is about grasping why these meetings occur, why they always happen on weekends, and why they signal that the system has lost all control. If you really want to understand what may happen next, you need to understand this moment right here before the market open. If this deep dive helps you see the rig clearly, subscribe to the channel and comment 1 below so I know you are following this Stacker series very closely. To understand why these emergency meetings always happen on weekends, you need to understand leverage, not the buzzword, but the raw math that sits underneath the entire global financial system. Banks and large funds do not trade silver using their own capital. They use borrowed fiat, rehypothecated collateral, and assumptions that volatility will stay contained. As long as prices move slowly, the machine works. It looks stable, it looks intelligent, it looks controlled. But leverage is asymmetric. It rewards calm and punishes chaos. A position leveraged 20-to-1 can survive small moves and still print steady profits. But the moment the market moves 5% in the wrong direction, the entire equity cushion is gone. There is no gradual loss. There is no recovery window. There is only absolute failure. And when silver moves 10% in a single session, the math simply stops being negotiable. Right now, any entity that was short silver with leverage above 10-to-1 is on paper insolvent. Their equity has been vaporized. They owe fiat they cannot produce. Under normal circumstances, the response would be very simple. Issue a margin call, force liquidation, close the position. But markets are not mechanical when the counterparty is too large to fail. What happens when the losing position belongs to a systemically important bank or a huge industrial hedger or another financial firm tied into the same clearing network? You cannot liquidate them without detonating the rest of the entire market. That is when the phone calls start. Regulators are notified. Central banks are looped in. The language shifts from trading to stability. This is why the weekend matters. Markets are closed, prices are frozen, time is bought. Decisions can be made without public panic. The goal is not fairness. The goal is survival. The system needs a bridge from Friday's close to Monday's open without admitting that something deep has broken. History is very clear on this. When leverage explodes, rules change. They changed in 1980. They changed in 1998. They changed in 2008, and they always change quietly while the sheep are distracted. That is the real purpose of this meeting, not to stop the rip, but to manage the damage. And once you see that, you realize this is not strength. It is an admission that control is lost. When markets lose control, stress does not show up first in price. It shows up in the plumbing, the clearinghouse. This is the crucial, invisible backbone of the fiat system. It guarantees every trade, every settlement, every promise made between counterparties. Most stackers never think about it because it is designed to be boring until it isn't. If a major player fails, the clearinghouse absorbs the loss using a default fund funded by its member banks. This fund is the ultimate insurance policy. But it is built on assumptions of normal volatility. A 10% move in silver breaks those assumptions instantly. At prices near 79, the notional exposure of shorts is massive. If silver gaps higher again, losses accelerate. They do not rise slowly, they cascade. And once losses approach the size of the default fund, the problem stops being about one bank. It becomes existential. This is why exchanges have emergency powers, margin hikes, position limits, trading halts, liquidation-only rules. These tools are not about protecting investors. They are about protecting the clearinghouse. Because if traders lose faith that trades will settle, liquidity vanishes and the whole market freezes. Behind closed doors, risk managers aren't debating price. They are debating thresholds. How much pain can the system absorb before trust totally collapses? How much intervention is needed to survive until Monday? Every option has consequences. Every rule change signals weakness, and every attempt to contain volatility exposes how fragile the structure really is. They are not managing a market. They are simply trying to keep the lights on. The next pressure point is collateral. This is where the situation becomes truly dangerous. Banks do not just trade silver in isolation. Every leveraged position is supported by collateral, and most of that collateral is government bonds. Treasuries are supposed to be the safest asset in the world. They are the true foundation of trust inside the financial system. But right now, that foundation is cracking. Bond prices are falling, inflation expectations are rising, political risk is back on the table. This means the value of the collateral is dropping at the exact same time the losses on silver positions are exploding. This is a massive double squeeze. On one side of the balance sheet, banks are facing margin calls on their silver shorts. On the other side, the bonds they pledged as collateral are worth less every hour. To survive, they need cash. And when banks need cash fast, they sell whatever they can. Not because those assets are bad, but because they are fully liquid. This is how a silver squeeze spreads into everything else. Stocks can fall. Crypto can drop. Not because their fundamentals changed, but because silver losses must be paid. Liquidity is being sucked out of the system to fill a growing hole in the precious metals market. This is the moment where a commodity event becomes a macro event. The weekend meetings are not just about silver. They are about preventing a liquidity crisis across markets. Risk managers are trying to ring-fence the damage to stop a localized failure from becoming truly systemic. But there is a problem they cannot escape. They can control paper markets. They can change rules on futures exchanges. But they cannot control the physical market. They cannot control Asia. They cannot control what happens when paper prices disconnect from real-world physical supply. If they tamp down this price on screens, the physical market simply decouples. Premiums rise, metal flows east, vaults drain. Every attempt to control price accelerates the loss of inventory. The system is trapped between stability and reality it always wins. When control over price begins to slip, the next battlefield is psychology. This is where narrative becomes a weapon. Whenever emergency meetings happen, a message usually follows. It leaks quietly into the media. Calm language, reassuring headlines. Regulators are monitoring volatility. Banks say liquidity is ample. Analysts warn of a shiny speculative bubble. This is not information, it is influence. The goal is simple. Scare weak hands into selling at the open. Banks need liquidity. They need someone to take the other side of their trades. And retail fear is the fastest source of physical supply. But this time the narrative is failing. Confidence in institutions is already fractured. People are no longer listening to official statements. They are watching the price. They see silver at levels that were supposed to be impossible. They see gold holding strength. They feel inflation in their daily lives. The story on the screen does not match the story in true reality. When confidence breaks, words stop working. Meetings stop working. Only price remains. And price is moving in the wrong direction for those in total control. The irony is brutal. The leverage used to suppress silver is now the same leverage driving it higher. The rules designed to protect the system are now trapping it. Every attempt to talk the market down simply confirms the problem exists. This is what system stress looks like. It does not announce itself with alarms. It leaks through disbelief, through contradictions, through narratives that no longer persuade. The market senses this weakness before the general public does. This is exactly why this moment is critical. It is not just about the shiny metal, but because faith in the system is breaking. And once the herd wakes up, the rigged market never goes back to sleep. Right now, the question is not if the tamp is coming, but how hard they will smash it. When the squeeze tightens, the COMEX grabs the panic manual. The first weapon is always margin hikes. By spiking the cash to hold contracts, they force the paper speculators to fold their hands. We have seen this trick fail before. Margins were hiked, yet the spot price kept climbing. This tells us the game has changed. This rally is not driven by paper speculation anymore. The buyers standing firm are not using leverage. They are taking delivery with cash. This changes the whole dynamic. Margin hikes hurt the little guys, but do zero to stop the whales' nations or industries draining the vaults. These heavyweights welcome the higher margins because it shakes out the weak paper hands and leaves more physical metal for them. The next desperate tool is position limits. The exchange can force whales to reduce exposure by capping contract sizes. On paper, this seems strong, but real capital is mobile. If one venue restricts positions, demand migrates. London, Shanghai, over-the-counter deals. You cannot fence in a global silver squeeze with local rules. The final option is the most dangerous liquidation-only trading. They turn off the buy button and only allow selling. It crashes the price, but the cost is massive. It destroys all trust in the market. Traders do not forget when the rules are changed in the middle of the game. Every tool the authorities use carries a heavy price. Each intervention props up the system for now while rotting it out long-term. The more aggressively they manipulate the market, the faster real capital looks for the door. That is why these emergency meetings are panicky. There is no easy fix. Every choice triggers a different collapse, and the longer they wait to act, the narrower their escape path gets. The hard limit in this market is not paper. It is the physical supply. This is where the fraud finally runs out of room. The paper price can be managed, rules can be changed, and screens frozen. But physical silver cannot be printed on demand. It must be dug up, refined, shipped, and delivered, which takes time the system no longer possesses. As the paper price becomes unstable, the physical market detaches. Premiums rise quietly, then violently. The inventory disappears. Dealers stop listing stock and start rationing what remains. Replacement risk becomes the top worry. When the rigged price loses credibility, supply vanishes almost overnight. This creates a feedback loop. Every attempt to tamp the paper price spikes demand for real metal. The arbitrage drains Western vaults and sends the shiny east. Once physical silver leaves the COMEX, it rarely comes back. The paper market becomes a hollow shell without any substance. The miners see this shift clearly. They are not forced to sell anymore. With supply tight and demand ripping, holding back ounces makes sense. Why sell the metal today at a fake price when tomorrow could bring true discovery at a higher level? Strategic withholding becomes their leverage. Industrial users feel the heat next. They cannot wait for the tamp to end. They need silver to build. When supply chains break, the game changes. Companies stop buying just enough and start grabbing everything they can secure. Panic buying replaces efficiency. This is how real shortages happen. Not from demand spikes, but from a total collapse of trust in delivery. At that stage, spot price means nothing. Access is king. And when the metal gets scarce, the market moves with a violence that the bank models cannot handle. Once physical supply becomes the hard limit, the crisis moves beyond markets into geopolitics. Silver is not just a chart play. It is a strategic material. It sits inside electronics, green energy, defense tech, and industry. When prices surge and shortages appear, the governments start watching. Major producing nations understand their leverage. Mexico alone accounts for a significant share of global silver output. When prices rise rapidly, political risk rises with them. Export controls, windfall taxes, or strategic reserve policies suddenly become real. These are not radical ideas. They are standard responses when a country controls the metal the world needs. For the bullion banks, this risk is unhedgeable. You cannot hedge a sovereign decree. You cannot model a political shock. If a producing nation blocks exports or demands domestic hoarding, the supply chokes instantly. Prices gap up before the paper market can even react. At the same time, corporations are scrambling. Tech and manufacturing firms cannot afford to stop the lines. Procurement teams stop caring about price. They only care about availability. Long-term contracts get signed off market. Future production is pre-sold. Metal vanishes from the public exchanges without ever touching the vault. This creates a two-tier market, a public paper price that is volatile and fake, and a private price that is higher and hidden. Banks are trapped in the public casino trying to cover shorts in a pool that is being quietly drained. This is how financial stress turns into strategic panic. The market stops asking what silver is worth and starts asking who has it. And once that question is asked, price becomes a political outcome, not a financial one. As the pressure builds, something else begins to surface: failure rumors. Every crisis has a weak link the herd does not see until it snaps. Not a big bank, but a shadow player, a commodity fund, a trading house, an entity operating with massive leverage and zero oversight. These firms live into the cracks of the system. They borrow short, bet big, and pray for calm markets. When volatility spikes, they have no shield, no safety net, no bailout. And when they blow up, they do not go quietly. Forced liquidation is a machine. It does not care about fair value resistance lines or charts. It buys because it has to. When a massive short position gets blown out, the covering order is pure panic. It chases the price to the moon regardless of cost. This is how melt-ups are born. The timing makes it worse. Holiday volume is thin. Order books are empty. A single forced buyer can move the market violently. This is why gaps form, not because of hype, but because nobody is foolish enough to sell. At the same time, the retail crowd is waking up. Search trends spike. Social feeds light up. People who ignored the shiny for years suddenly notice it breaking levels that were once unthinkable. But access is tight. Physical is scarce. The local coin shop is sold out. ETFs are paper traps. So capital flows where it can. It floods straight into the mining stocks. This is the path of least resistance. The apps are open. Tickers are liquid. Exposure feels easy. And when millions of small apes move at once, the effect is explosive. Stocks that were ignored become crowded overnight. Liquidity floods in faster than the fundamentals can adjust. This is how a metal squeeze spreads. From futures to physical to miners, each layer pumps the next. By the time the public gets in, the foundation is already cracking. And once that happens, the price acceleration becomes self-feeding. We have arrived at the moment of truth. This weekend was not just volatility, it was the pivot. The panic meetings, the rule changes, the stress in the plumbing all point to one thing. The old system is dying. When markets need backroom deals to survive, price is not discovered. It is managed. And managed prices always fail. As markets reopen, the volatility will be wild. Gaps will form. Headlines will flip. Emotions will run hot. The biggest mistake stackers make now is confusing noise with signal. A sharp drop does not mean the thesis is dead. A sharp rally does not mean it is over. In a reset event price, swings are just noise around a true repricing. The lesson here is not just about silver. It is about leverage, trust, and scarcity. Systems built on debt fail when volatility returns. Assets that can be printed lose value. Assets that are finite regain it. This cycle repeats throughout history, and every generation learns it the hard way. Strategy is everything now. Chasing every candle invites ruin. Panic selling feeds the very banks that rigged the game. The strongest position is clarity. Know why you stack what you stack. Know the difference between paper promises and real ownership. Manage risk, but hold the line. Above all, remember this: markets do not move to make you comfortable. They move to force you out. Those who survive are not the loudest or the fastest. They are the ones who prepared. This is not the end of the squeeze. It is the start of a new era for real value. If you want to stay ahead of the reset, if you want the truth, without the hype, make sure you subscribe to the channel, smash that like button, and share this with a fellow stacker. And leave a comment below because our voice matters now more than ever.